Welcome to the deep dive. Today, we're going to take a scalpel to the financials and the strategy of a really big player in e-commerce, Chewy.
hmm
We've got the full source material from their Q3 2025 earnings call, which takes us right up through early November.
And this is it's a fascinating business case. The goal for us here isn't just to read off numbers.
Yeah.
We want to understand how they're pulling off something that's frankly pretty rare in this market.
Which is,
Growing profits so much faster than sales while they're still outperforming the rest of the pet category.
it's a classic efficiency story, and their long-term goal is huge, a 10% adjusted EBITDA margin. This quarter really shows they're on that path.
They are.
Okay, so let's unpack this. We have to start with the big headline metrics from Q3. They really, they set the stage perfectly,
They really do. So net sales grew 8.3% year over year.
which hit $3.12 billion.
Exactly. And that already beat the high end of their own guidance. But the really crucial detail here, the foundation of that growth was unit volume,
Not price increases.
not price increases.
That's a huge deal. It means the growth isn't just, inflationary fluff. It's a real competitive win.
Right. They sold more stuff.
So that's the top line. How much of that actually made it down to the bottom line?
Well, this is where the story gets pretty dramatic. Their adjusted EBITDA, so their core profitability,
Uh-huh.
it shot up 30% year over year to $181 million.
Wow. 30% profit growth on just over 8% sales growth. I mean, that's the definition of operating leverage right there.
It is. And that pushed their adjusted EBITDA margin up to 5.8%. That's 100 basis points of expansion.
And for anyone listening, 100 basis points is just one full percentage point.
Exactly. And what that margin improvement tells you is that for every new dollar of sales they brought in, about 18% of it flowed straight to profit.
18% flow through. That's an incredible conversion rate. What's making it stick? Are they just squeezing their suppliers?
It's a lot more sophisticated than that. Their gross margin expanded by 50 basis points,
So half a percentage point.
right, pushing it to almost 30%. And management was really clear that this gain is structural. It's embedded, not some temporary thing.
Okay, so what are the drivers then, the structural ones?
There are really three. First, the growth of their sponsored ads business.
Which is very high margin revenue.
Very high margin. Second is the sheer reliability of their Autoship customer base.
Mm-hmm.
And third, a favorable category mix. People are buying more health products, more specialty items.
So they're making more on what they already sell, and they're getting people to buy the higher margin stuff.
You got it. And that efficiency is just generating a ton of cash. Free cash flow was $176 million.
That's up nearly $70 million from just the last quarter.
And with that strong cash flow, they can be opportunistic. They actually used $55 million of it to buy back their own shares.
Which is a classic confidence signal from management, right? It tells the market, we think our stock is undervalued.
Exactly. It says, we believe in the resilience of this model.
It's like they're self-funding their own growth and rewarding investors at the same time. Okay, that resilience is the perfect pivot. So the money's flowing, but who's spending it? And how are they keeping them?
Well, that takes us to the customer side.
And that powerful Autoship engine.
Right. When you look at customer health, the metrics are really robust. They ended the quarter with 21.2 million active customers.
That's up almost 5% from last year.
It is. And what's important is that they're seeing improvement across the whole funnel. They're adding more new customers, and they're keeping the ones they have. Churn is down.
And those customers are spending more? That's the NSPAC metric, right? Net sales per active customer.
That's the one. NSPAC, basically how much the average customer spent over the last year, hit $595.
Also up nearly 5%.
And when you see that number climbing, it means people are trusting Chewy with more than just the big bag of dog food.
They're getting the treats, the pharmacy stuff, everything all in one place.
It's that consolidation of spend. And all of that feeds the main engine, Autoship. Those recurring subscription sales grew 13.6% to $2.61 billion.
And that's way faster than the company's overall growth of 8.3%.
Way faster. It's now, almost 84% of their total sales?
83.9%. That sounds less like a retailer and more like a utility subscription service.
Well, that's the structural advantage, isn't it? It's that predictability.
Because if you know what millions of people are going to order next month,
You can optimize everything. Warehouse staffing, inventory, logistics.
yeah,
It just drives costs down and margins up.
and you can see that efficiency in their marketing spend too. They got 40 basis points of leverage there.
Right, bringing it down to 6.3% of sales.
Mm-hmm.
And it's not because they slashed the budget. They just got smarter.
More precise.
Much more precise. You've got more people coming directly to the site. The mobile app is way better.
Yeah.
App customers and orders were up about 15% year over year.
And app customers are the best customers. They're the stickiest.
They're gold. So they're improving their LTV to CAC ratios, lifetime value to customer acquisition cost.
So they're getting customers who cost less to acquire, but who spend way, way more over time.
It's that flywheel just constantly reinforcing itself.
Okay, this is where it gets really interesting for me. How are they compounding this? Because they're not just resting on Autoship. They're building this, what the CEO called an intersecting Venn diagram.
Right. Autoship, Chewy Plus, and Chewy Vet Care.
These are the big bets.
These are the high ROI bets designed to just deepen that customer relationship. Let's start with Chewy Vet Care, or CVC.
The vet clinics.
Yeah. And this program is, by all accounts, exceeding their expectations. It's all about recurring, high-margin services.
But vet clinics are brick and mortar. They're expensive. How fast are they actually scaling this?
They're being very deliberate. They're up to 14 locations now across 5 states. They just opened their first one in Phoenix.
And the goal for the year?
On track to open between 8 and 10 this fiscal year. But the goal isn't just revenue from the vet visit itself.
Of course not. It's the ultimate retention tool. If you use their vet, you're almost certainly using Autoship for everything else.
It locks you into the ecosystem. And strategically, CVC expands their total addressable market, their TAM, by an extra $40 billion.
$40 billion in health services. That's a huge runway.
It is, but wait a second. If the whole pet retail market is only growing in the low single digits, doesn't that $40 billion TAM feel a little optimistic for the short term?
That's a great question, and it is a massive number, but it represents the potential market they're entering, not their immediate revenue goal.
So it's about redefining what Chewy is.
Exactly. They're moving up the value chain into services where the margins are naturally higher and, the competition is mostly local, fragmented players.
Speaking of moving into new areas, they just made a really interesting acquisition, Smart Equine.
Right. Outside of the usual dogs and cats.
On October 30th, they bought Smart Equine, a major brand in horse health. This is a very targeted, very high-value play.
And I saw that the deal is expected to be immediately accretive to their EBITDA margins.
Which means it helps their profitability from day one. It just tells you they bought a really solid, profitable business they can layer right onto their existing platform.
It's a textbook bolt-on acquisition.
Yeah.
Okay, so now let's talk about the glue that's supposed to hold all this together. The Chewy Plus membership.
Chewy Plus is designed to be the accelerator. The goal is to get customers to discover all the other things Chewy sells beyond just, food and medicine.
The hard goods category, beds, crates, toys.
Exactly. And they're targeting a very specific customer.
The mid-range spenders.
The ones spending between $300 and $700 a year. They want to use the Plus program to turn them into high spenders.
And they must feel pretty good about it because they just hiked the price.
They did. From the intro price of $49 a year up to $79.
That's a big jump.
It is. But the early data seems to back it up. They're seeing strong conversion from free trials to paid, even with the price increase. And the key metric is this. Plus, members are already delivering gross margins in line with the rest of the business.
And are they actually buying more of the other stuff?
They are. Penetration into hard goods and those specialty categories is running significantly higher for Plus members. The program is working.
Okay, that all makes sense. It's working as designed. So let's shift to the future. What does 2026 look like, especially since the macroeconomy isn't really helping much?
Well, management is pretty cautious on the external view. They basically said 2026 is going to look a lot like 2025.
Meaning soft industry growth, low single digits.
Yeah, they're still waiting for a big signal, like a huge jump in pet adoption rates, to say the market is back to normal.
So if the overall market is basically flat, their internal plan has to be all about taking market share.
It is. The plan is explicitly share-taking growth. They said they want to grow at about twice the market rate.
So if the market grows 2%, they're aiming for 4% or more.
That's the plan. And they expect a little bit of help from pricing next year, unlike this year, which was near zero, but the focus is still on that structural unit volume growth.
And to do that while expanding margins, you need incredible discipline with your spending.
Absolutely. And they drew a really clear line between temporary costs and foundational investments.
What's an example of a temporary cost?
Things like the initial big inventory buys for the fresh food launch, or the early marketing incentives for Chewy Plus. Those are one-time hits that just fade over time.
And the foundational stuff, the investments that stick around.
That's the automation in their fulfillment centers and scaling up CVC. Those are long-term strategic plays with very clear ROI targets.
So as we go into 2026, we should see less spending on those temporary launches.
And more returns, more operating leverage from the big foundational investments like automation as they really start to scale.
You know, this whole deep dive from the 30% profit growth to the vet clinics, it all really comes down to one thing.
Confidence.
Confidence.
It does. The core message is that they feel very confident they can reach that long-term goal of a 10% adjusted EBITDA margin. The engines are just getting stronger.
Right. Autoship is the base, plus accelerate spending, and health opens this huge new market.
And they're proving they have the operational chops to actually monetize all that strength.
The results just underscore the power of a recurring revenue model in a stable industry like pet care. The next stage of growth, the real compounding, isn't just about getting new customers. It's about converting their existing ones into these multi-program members.
The ones who use Autoship and Chewy Plus and Chewy Vet Care.
Exactly.
Which brings us to a final thought for you to consider. The company is telling us the industry outlook is essentially flat for 2026. Household formation is low, adoption rates are still down.
So the environment is still tough.
Very tough. So the question is, how much market share can their internal flywheels Autoship Plus and CVC realistically capture before the external market finally gives them a lift? It's this race between their own operational gains and a stagnant market. They're controlling what they can control, but that external environment is still the big question mark. That's the tension to watch.